Okay, once a company has grown to a certain size and is more stable and has a credit history of paying back its debt, then they can go ahead and they have many more um, financing options. And so, first of all, they can take out various kinds of loans, which I'm not going to go into a lot of detail about right now because a loan is just a loan. I do want to note one kind of loan which you may have heard of, which is called a line of credit. Um, Lines of credit are short term loans that are expected to be paid off right away. It's kind of like a credit card. And the purpose of lines of credit is to smooth out cash flow for seasonal businesses. And so, a mature business has a number of different sort of day-to-day financing options for purchasing capital equipment, for smoothing cash flow, etc. But, right, what we're interested in is bonds and stock. Where do bonds and stock come from? Well, once a business grows to a certain size and has established itself in an industry, the capital markets become an available financing source, right? So this is above and beyond banks. Now they can go out to Wall Street and get money from the whole market of financial investors. And so what we want to talk about is how these securities are issued, okay, how you create a bond. So the first thing to note is that bonds are usually very long-term financing, and they're usually issued when a company needs more money than a bank can do in a regular loan. And so, first of all, companies that need to issue bonds, they work with an investment bank. And investment banks are different from the regular banks that you and I know, although now, since around 1999-2000, many banks have investment banking arms or partners or subsidiaries. If you look up on Wikipedia the list of investment banks, you'll see some very familiar names here of banks that have investment banking arms that also are, banks that we see on Main Street. So J.P. Morgan Chase, a large credit card issuer, as well as an investment bank. Goldman Sachs, one of the very well-known investment banks. Bank of America, B of A Securities, Citigroup, Barclays. All right, so these are all investment banks, and what they are is they do a number of things, but they sort of intercede between businesses and the financial markets. They create these financial instruments for companies to use to raise capital, and they go ahead and they market them as well. Right, so an investment bank will put together a package, and then they'll go out and do what they call a dog and pony show, trying to work up interest in selling these financing instruments. And the reason that I'm kind of stumbling is because the work that I've been associated with investment banks actually was with project financing, which is another area of finance. But one of the things that investment banks do is they put together a bond issue. So they take they create the bond terms, so the coupon rate, the face value of the bond. They take care of marketing the bond, and then they auction it out in the market. Okay. One other thing is that bonds are rated by outside agencies, and one of those outside agencies is called Moody's. Another one is called Standard & Poor. Moody's is the one that I'm more familiar with because my former husband worked there right after college. This is the kind of place where you could get a job on Wall Street as a college grad, doing, detailed analysis to support the rating of bonds. Rating of bonds, we'll get into that, I believe, in Chapter 6. We'll look at that. So the investment banks create the bonds. The rating agencies, they grade the bonds to determine how much risk there is. And then the investment banks go around and sell them through various mechanisms, right? So that's where bonds come from. And then there's the question of where does stock come from, right? And so, again, we're going to go through some detail about how to value stock, but the question is, where does stock even come from in the first place? So when a corporation first starts up, right, some people get together and they decide to start a company together, and they, just like in your financial accounting examples, they'll put some money into a company in exchange for the issue of a certain number of shares of common stock. And, eventually a company needs to get more capital investment. They can do that either, as we discussed, through getting loans. But at a certain point, it's not good for your company to rely too much on loans, and or you won't be able to get any more loans. That's not a very strong balance sheet. At some point, you have to get more equity investment. You can do that, of course, through increasing your retained earnings, or you can do it by issuing more stock. And if you go out into the public stock markets with this stock, and anybody can just buy it, right? That's called an initial public offering, an IPO. Right? And so I've looked up IPOs in 2019, and here are a whole bunch of companies you never would have heard of. So one initial public offering that you might be aware of was Facebook. They went public in 2012. I remember this because it was just so heavily hyped. I mean, it was the news of the day during those days, and it happened to be my birthday. So they launched at $38 on May 15th, 2012. If you had invested $10,000 in that company at its initial public offering, you would have received 263 shares of Facebook common stock. So the price was $38, and then it dropped right away. It was sort of overhyped, and this happens. IPOs often occur at a premium to what the price settles at immediately afterwards. But let's look at what the price of that stock is now. $244. So it's gone up tenfold, right? So that's what IPOs are, and that's where stock comes from. Okay, stock that is sold on the market. So again, to sum up, once a company is mature, it has some options that startups don't have. And two of those options are to issue stocks and to issue bonds. Stocks and bonds are issued via a fairly similar process. They both involve investment bankers coming in and helping the company to package and price and market the stocks and the bonds. Both are long-term financing options. Bonds are often issued for 20 to 30 years, and stocks are just stock. Once it's issued, there's no intention of paying it back in any way except for providing dividends. It's equity. And so, that's where stock and bond come from. So now what we're going to do is go back to chapter 6 and 7 and talk about how they're priced and how they're valued.